Now let's talk about the income statement. This is Module 2, Learning Objective 2. The income statement tells you all about profitability, and profitability is based on the formula revenues minus expenses equals net income. Revenues minus expenses equals net income. There's going to be other items in here. And the income statement is going to have all this information on it. And here you can see an example following all the different steps that we've had. They also include here discontinued operations. So here's an example of an income statement for Apple. And it's important for our purposes to differentiate between operating expenses versus non-operating expenses. Remember, we're splitting the company. There's 4 areas of operations. There's planning, financing, investing, and operating, right? So the top half for the income statement, everything from operating expenses up, is considered to be operating. The bottom section is non-operating, could be investing or financing. Recognition of revenue is based on the revenue recognition principles. And these are based on when the company does what it's supposed to do in order to earn the revenue. In other words, when a customer pays you, you're expected to do certain things. So when you do those things, you've earned the revenue. And that's called the revenue recognition principle. That's putting hundreds and hundreds of pages into a simple 2-sentence summary. When you've done what you're supposed to do to earn the revenue, you can recognize the revenue. Now, expense recognition, expenses are matched up to revenues. In other words, remember that I said that expenses give you a benefit. The benefit is usually sales. So when you have the expense, you're going to have revenues that expense generates. So you're going to record the expense in the period when the related revenues happen. In other words, you match your expenses up to your revenues. A perfect example of this is cost of goods sold. You record cost of goods sold when you sell the goods. So the expense, cost of goods sold, matches up to the revenues. Most expenses you can identify. Let's take rent as an example, right? Rent would be recorded not when you pay for the rent, but rather when you use the space that you're paying the rent for, because using the space is the benefit. So you record the revenue as an expense when you actually use the space. So if you pay for a full year's rent and expense, you record 1/12 of that every month. Same thing advertising. Let's say you pay for a year's worth of advertising in advance. As you run the ads, you get the benefit from the advertising expense. So you record the revenue as you run the ads. And these are very basic foundations of how accounting works. Discontinued operations goes at the way bottom of the income statement because it's so strange and unusual that it will have no impact on the future. Because once you've made a decision to discontinue operations and sell part of your business, then that's separate from the rest of your business. Because this is not going to be in the future. We're interested in the future. We're going to use future performance to measure the value of the company. If you discontinue an operation, that's no longer part of your future performance, and therefore it needs to be separated from the rest of the business. So discontinued operations actually has 2 pieces to it. One is your profit or loss from that particular segment that you're discontinuing. And the other piece of it is if you're selling the business, the gain or loss from the sale. So all that gets put on the way bottom of the income statement as the very last item before you arrive at net income. Now you can only do this if it's a big change. If you shut down a factory, but you have other factories that are like it, that's not a discontinued operation. This would be where you take an entire line of business and you close it down as a big decision about how to run your business in the future. A key ratio used for analyzing the income statement is gross profit margin. And that would be gross profit divided by sales. Again, remember what gross profit is. That's sales minus cost of goods sold up here. Net sales minus cost of goods sold equals gross profit. So gross profit divided by sales. And this would tell you in a way what the markup is on sales. Now there's also, they go into it here, margins for operating expenses, operating expense divided by sales, and this focuses on overhead and how high the company's overhead is. Next, we're going to talk about the statement of stockholders' equity.